And I'd like to welcome Michael Harvey of MDH Accountants back to Seedlab Tasmania today. We find these monthly sessions very useful for our team, and we've taken them on a various journey of topics, and today's topic by request was forecasting and depreciation. So I can't even say it. So off you go, Michael.
All right, thanks, Hazel. Two probably disconnected topics, but we'll blend the two together as we go through the presentation. So I'll just share my screen. All right, so forecasting and depreciation, today's topic. So I'll put it in a context because forecasting can be quite broad, but the key element for myself looking at businesses is at the end of the day is cash flow. So today I just want to scope it around cash in, cash out, just sort of really break it down to what the key cash flow movement looks like for a business. So cash in is predominantly going to be all about sales. Cash out, it's your cost of sales, your production costs. Most businesses have wages. What might have a stock element. They need to build up their stock and inventory levels to be able to produce the goods for future sales. There's equipment to either purchase or lease or asset finance. There's drawings or living expenses. There's BAS and GST to consider. And then there's PAYGI or income tax elements as well. Those last two can be a bit lumpy as well, and some businesses can leave themselves a bit short in those quarterly cycles. So cash in, so what are the elements of cash in? So pretty much your sales forecast. So it's looking at your volume. So it's looking from a production perspective, but they're also looking from a sales unit perspective. So breaking that down into, into non-monetary values initially to say, okay, these are the number of units I'm planning to sell, these are the future orders from customers and things like that. So looking at volumes, looking at price points. So that's looking at your distribution channels, might be different pricing for distribution channels. So if you're operating in the retail market, Coles and Woolworths, I'll put in there on the slide, it's a net is what you sort of look at, because some of those larger retailers, they might take a discount for rebates for on sale items and things like that, or settlement discounts as well. If they pay you early on time, they'll take another % or two, things like that. So matter of looking at your price points like that. So that gives you sort of your sales volume and sales dollar budget. And then another consideration is credit terms. What credit terms do you give your customers? Because then that then translates into with the timing of when you're going to receive those receipts. So if it's 30 days in the month or cash on delivery, they're sort of variables to build into a forecast. So cash out, the first element's production. So once again, we're looking at volumes or unit sales types of arrangements. It's 1,000 units a week, or it's 2,000 a month, those sort of things. In agriculture, you're looking at stock or feed costs that need to be built in, because there might be a sort of a long lead time if you're fattening cows and stuff like that, and then other costs to be factored in as well. Then you're looking at the time frames. So you're looking at what your lead time might look like. So depending on the nature of your business, you may need to increase inventory over a period of time, or it might be a type of, say if you're growing salmon, say, it's sort of more of a crop or a harvest period over a shorter period. Yeah?
Sorry to interrupt, we've just got a question.
Yep.
Can you explain net again? He missed it and he's not sure what you mean.
Oh, so net is, so if you're dealing with Coles and Woolworths predominantly, they'll often, you'll have a price you're selling for, then they might have some discounts that they are entitled to that they'll claim. So like a settlement discount, which is if they pay within 7 days rather than 14 days, they might take a 1% discount off that price. Or there might be a discount that they have in that contract for either a contribution to a promotion, or sometimes if you agree that, okay, that product's going to go on sale for this period of time, then you have a contribution to that, and your price point effectively gets adjusted. So I suppose that the point is that just watch, sometimes your headline number may not be what your net return looks in some of those larger retailers. Hopefully that's answered that. So looking at stock, and so lead times as well. So that comes into your cash flow forecast in terms of either time it might take to produce the goods that you're selling, or certain, just started to quote the salmon industry as an example, there's only certain time periods you can harvest that in quantity, so therefore you need to build up stock before you can harvest the fish. Other sort of production methods where it might be more efficient to do it in batches rather than individuals. So then you've got I suppose a holding cost that you need to factor into your forecast, that you need to produce a batch of those goods rather than individual units. Once again, you're looking at credit terms from your suppliers, the reverse of what credit terms you give to your customers. That comes into play as well. So there's other cash out to factor in. So it's your selling costs. So they are variable, but if you have some freight component where you need to deliver those goods to your customer and it's your cost, you need to factor that in. An example, that's discounts I've got there, that comes into your net. If you're offering a discount for a certain promotion or a certain settlement arrangement. You might have consignment type of arrangements as well, so that sort of comes into your selling costs. And then you may have a sales commission. Some people have distribution channels where you may give a distributor a percentage or a cut of the profit for that product to go through their distribution channel. So there's a bundle of selling costs, getting your goods to the end consumer. So another cash out component is wages and on-costs. So net wages is the wages that you pay your employees into their bank account each fortnight or week, whatever your pay cycle is. So bearing in mind that when you're forecasting, there's the PAYGW you withhold from your employees, that will then need to be remitted back to the tax office wherever you do your best. Superannuation, currently quarterly, so there's a net wages, but also there's a 9.5% of their gross that you need to factor into your cash flow forecast to pay for the super on your employees as well. We've got that down there, looking at your PAYGW cycle. So if you've got employees, typically it's a quarterly cycle that you need to have factor that into your cash flow forecast. And workers' comp insurance, that's just another cost of employing people. Typically, it's an annual charge, but then some people go on a premium funding type of model with their insurances, which spreads the cost over a sort of 10 or 11 month period. So other costs, so your overheads, your rent, your power, insurance, any vehicle costs, things like that, all need to be included in your forecasting. Other outflows, so equipment, so that might be either equipment you need to fund yourself, or you may need to get finance for that equipment, and so you've got lease repayments or asset finance loan repayments. Any stock or ingredients you need to buy, so there might be a certain ingredient into your production process that you need to factor in to be buying sort of quantity rather than buying it in hundreds of grams. You might have to buy it in kilos and stuff like that, so factor that in as well. And then the other one is to factor into your cash flow living expenses. So the rule of thumb I always say is, even if you start with a sole trader, work out what you need from the business to survive and put that money aside into a separate account. Don't run your living expenses from the business. So come up with a sort of an internal budget and move that to a separate bank account. Was there another question, Hazel? Or? No, all right. I'll keep going into just the final one on cash out. So as I said, your quarterly cycle, so it's something to really plan for, your BAS and GST. Often I recommend people to have a separate bank account to put that money aside because effectively, depending on what the nature of the business is, you've got that PAYGW that's owing each quarter. And then the PAYGI, pay-as-you-go instalment, or related to the income tax system. Once again, depends on the nature and structure of your business. There's something to factor in to your cash flow as well. So I'll just come up with an example. So I'm just doing egg production. So just chicken farmer producing eggs to the retail market. So you look at this. This is looking purely at volume. This is like a sales budget to start with. You look at that. We're looking at volume, October, November, December. So we're looking at a quarterly. Quarters are quite a good cycle. Sometimes you need to do an annual budget if your sales cycles differently. But quarterly gives a pretty good snapshot of what it looks like for the next 3 months, and it lines up with your BAS period as well. So in this example, just broken it up into sort of type of eggs, so free range and other forms of farming, and then broken it down to 2 categories, 2 distribution channels if you want. So food services, that's selling to restaurants, things like that, and then the retail, your Coles, Woolworths, IGA. So I'm putting there volumes and see there, so in total 2,625 units or dozen eggs were going to be forecast to be sold in the October month, etc. So then part of that, then you build up, okay, I've got my volumes, what is my unit price? And this is the net concept that I've sort of talked about before. And so you set your price points. These are your average prices. So my target price for food services is $10, $9 for retail, etc. And the other types of $7.50 and $6.75. That way as well, you can vary it, and you can see there as just by way of example, I've said, oh, in December we're looking to increase our pricing by $1 a unit in December for free range through food services distribution channel. So it allows it, if it's built this in Excel, then you can have those variables that will flow through. So this one then is my heading's not right. It's not price per unit. This is actually the sales budget in dollars. So this is basically taking the volume of units by your unit price and coming up with a sales budget. So those variables means that 21,875 is like our sales forecast for the month of October in total. Also, to build into your forecasting is some of the variables, I call them. So the big one here, extrapolating dollars to, and in terms of sales, to cash inflows, and the same for purchases and when you actually pay for the goods. Just putting in there some examples of what you might say, what credit terms you're giving customers 30 days from end of month. Your feed supply gives you 30 days end of month. You pay your wages fortnightly. You're on a quarterly BAS, and other expenses you need to pay 14 days from invoicing. Depending on the size of the business, how granular you get in here, I tend to sort of use, it's still a forecast, so I use sort of larger brush strokes, but if your rent bill is quite a big part of your expenses and you have to pay monthly in advance, then you would add that into your variable and put that as a separate line. Other variables you factor in is just what company tax rate. So in this one, I've assumed it's operating in a company structure and putting that tax rate in to your forecasting. So then we're looking at the sort of a production. So production required, so that's the top line, so October 2,625. So that's the volume of eggs. And in this example, we need 536 chickens and lay to produce that volume just by applying some averages from that production manager. The big cost there is feeding them. So you look at feed volume, so you then look at extrapolation, number of chickens, how much they eat per day, per month, that sort of time period. Come up with a volume of what you need to buy in terms of feed. In this example, you can buy it by the kilo, so we don't have to factor in to our cash flow that you need to buy it in tonnes or anything like that. But that may be a different scenario for different people. How much we pay per kilo for that feed, so it gives us our feed budget in this sort of livestock example. Other costs per production unit, so that might be, you know, sort of medical costs or other direct costs relating to producing those particular goods. So effectively, you've got total production costs of 12,321 is forecast to produce 2,625 dozen eggs in that month of October. So then strapping all this together, just by way of sort of a cash flow forecast, so we can see the cash in for debtor receipts, because our assumptions was that we don't get paid for 30 days. So in this theoretical example where we sold the eggs, we're not going to get paid until November for that. So I suppose it's just a theoretical example to show how there's going to be a cash flow shortage until we get paid by our customers. On the flip side, if you look at cash out, our feed purchases, we've got 30 days credit from our feed supplier, so we're not going to have to pay that bill, $10,714 to November. So I've assumed that with sort of the 1st October is sort of a starting point for the business. In reality, if it's an ongoing business, then we would have receipts from September sales and prior coming into October. So just bear that in mind. It's sort of just a sort of theoretical example in that, just to demonstrate the point. So we've got feed purchases, other production costs, overheads. I've just put that there. It's very constant, this business. It's $5,000 a month, rent, insurance, paid by the month, etc. So I haven't got too fancy with that one. And so that, for this example, I've gone, the main variables are with your sales and your feed. And so that's where I'll put my energy to produce this forecast. Whereas overheads, equipment lowering payments is a standard $2,000 a month. And the owner said I want $3,000 a month to live on minimum. So you can see in October, total cash out is $10,000, net cash flow is a negative $10,000. Then down the bottom, put the opening bank balance, $20,000, and your closing $10,000, and then they just flow through the future months. If you have an overdraft or a credit facility, then your opening bank balance might be the balance available under your credit facility as another way of doing it. In this example, I've just sort of said it's your opening bank balance. So I might just pause it for a minute if there's any questions on that as an example, or how it might apply to different people's business.
Anyone want to put your hands up if you've got questions, or yell out, or put it in the chat box? Ian looks like he's working up to one.
Right.
Do you want to unmute yourself, Ian?
I'm just saying that it's explained well and there's no questions so far from us anyway.
All right.
I think Rachel wishes she got those prices for eggs.
Yeah, I've deliberately made them a fictitious price.
Oh, phew, phew.
I don't know if I'm getting that. I just didn't want to sort of be too close to the action.
All right.
It's super organic eggs or something, $9.
Yeah, it's a pretty good price, isn't it?
They're cheaper than the eggs that my chickens produce based on the price of the chickens.
There you go. It's sort of, there might be some reality to it.
All right.
All right, well, I'll pause it and just go back to the other slides. So that's an example, or maybe real life, maybe not. And there's no questions on that. I'll just quickly go across to depreciation. That was another question from the group last time from memory. So I'll just use a really simple example that you buy some machinery for the business and it costs you $10,000 to buy. So my accounting theory tells me you amortise or depreciate that cost over the useful life of that piece of machinery. So the business owner estimates that's 5 years I should be able to get that, and then I need to trade in and get a new piece of machinery or upgrade it. So in simple terms, that's a depreciation charge of $2,000 per annum. So it's $10,000 divided by 5 years, so $2,000. That's accounting theory. What then happens, fortunately or unfortunately, we then have sort of tax principles or tax issues and tax offers get in the way. So then we have the government will announce a tax incentive. If you buy this machinery before the 30th of June 2020, $10,000 will give you immediate tax deduction of $10,000 in a year of purchase. So what does that do? That effectively gives you a tax depreciation of $10,000. It doesn't really change the nature of the accounting or the business fundamentals, but it does give you a tax incentive to buy that piece of machinery by certain dates. So what you do is you get the $10,000 in year one, in the year of purchase, and you forego the $2,000 per annum that you would have been able to claim in future years. So it's not a, it's a timing benefit, if you want a better word. It's not really an absolute benefit, because you get the $10,000, but then it's 0, 0, 0. So over a 5-year period, it's still $10,000 tax deduction, compared to if it was just normal accounting was applied to tax. Then you'll be able to get the $2,000 tax deduction over 5 years, still have the $10,000. Hazel.
We've got quite a few questions here. How is the estimated life determined? And are there standard depreciation rates for equipment recognised by the ATO? And a third one for you, is one way better than the other, or does it just depend on individual circumstances? I hope you understand where those questions fit in.
Yep. So there are some standard rates that ATO publish, and it's quite a detailed set of rates. They range from 3 years for computer equipment out to 40 years for building. So it's quite a broad range, and it's quite detailed. A few years back, they brought in what they call self-assessment. So that allows a business owner, in conjunction with their tax accountant, to come up with a reasonable basis for what their estimate is for that useful life for tax purposes. So if I buy a computer and I'm in the computer industry, I know that 3 years is too long to write that computer gear off, because in 18 months' time, it's useless, that particular piece of technology, I need to replace it. So I can sit down and self-assess and write that off over an 18-month period. If, from a tax perspective, if you elect to go into the, small business concession, then there's small business rules, part of which is immediate tax deduction. You don't actually get a choice. So if you buy a piece of machine for $5,000, but you want to amortise it over 5 years, the tax rules will say, if you tick that box to say I want to be in small business concessions, then you need to apply the immediate tax deduction, or you can untick your box and say I don't want to go into the small business concession pool and just do what they call self-assessment. As I said, sit down, use the ATO depreciation rates as a guide, and then come up with what you think is the useful life to write that off for depreciation purposes. I think it was 2 of the 3 questions. I can't quite remember the third one, Hazel.
Third one, is one way better than the other, or does it just depend on individual circumstances?
From a tax perspective, normal rule of thumb is it's better to claim it now. Yes, because you get the tax benefit now and save the dollars. Other people, like I had a guy the other day that we claimed the tax deduction for a vehicle 3 years ago, and then he traded in, and then he had a tax bill because the depreciated value of that vehicle was 0. And he said, I never want to do that again, because it's false economy in his mind, that he had a tax liability coming his way because he traded in the vehicle for 20 odd grand, and then that meant he had a tax bill on that 20 odd grand. So rule of thumb would always to bring forward your deductions, with that little caveat that it can create some problems down the track in terms of tax. But save your tax dollar today, I suppose. What's counterintuitive probably this financial year is some businesses will have a lower taxable income in 2020 compared to what hopefully their business will get in 2021. So the tax deduction might be better for some businesses to get in the 2021 year, not the 2020, where that is, to defer the tax deduction and receive that in future tax periods. It's a bit of a quirk, I suppose, because of COVID and some of the businesses that really won't have a taxable position this financial year in 2020. But ordinarily, you're better to do that, and we've seen that with Harvey Norman promoting all before June to get your tax deduction before the end of June, and the government have then extended that to the end of December now for the immediate tax deduction figures. So they sort of recognise that we're still in sort of a period that try to, from a political and tax perspective, or political perspective, really an economic perspective, they're trying to generate investment decisions and trying to bring forward. If I was thinking about buying a machine in 12 months' time, they're trying to bring that decision forward to stimulate the economy. That's sort of the economic perspective. Why they do it, it just muddies the waters from a pure accounting perspective. And most small businesses will make a decision based on the tax consequences of their purchasing decision. Always make your decision based on what's best for the business, and then look at the tax benefits down the track. But because they're there, it can sway people's decision making in terms of timing. Well, hopefully that's that. And any other questions I can take now?
Well, do you want to unshare your screen?
I can do that. Stop.
Yep.
Share. Good idea.
And everyone comes back into their full glory.
Yep.
Okay, guys, over to you lot.
So can I just ask a question, Michael? So does that mean that effectively as a business you may end up with two versions of depreciation on your books? The depreciation as considered by the tax office, and the depreciation is considered by your own internal depreciation figures?
Yeah, that's. I don't see a lot of it these days, but for a business of sort of a reasonable size, then we do end up with two depreciation schedules, because to me it can distort the true figure. And it's probably for a business. Say if you've got two investors involved with the business, then you really want to portray the true value of the business, not necessarily the tax value of the business. So it's been interesting. I've seen a few sales contracts on businesses, and the rule of thumb has been traditionally the plant and equipment at written down value, but with these incentives, written down value is probably much lower than what it would have been normally under sort of normal accounting depreciation.
Yeah.
So some people have been in court where on the contract they've sold their plant equipment for less than what they thought they're getting because it's tax depreciation. Yes, I don't want to overly complicate the small businesses, but if you've got in mind, so if you do have external stakeholders that you're reporting to, then we'd probably consider that having two depreciation schedules.
Yeah. Okay, that's good. Yeah.
The other thing I always make sure, even if you get the immediate tax deduction, I said put on your depreciation schedule and put it through as 100% depreciation rate. At least then you've got a proper asset register. Whereas I do see some people, they'll just write off to their profit and loss straight away. I said, well, you've lost your handle on what gear you've got.